What is happening, best ever listeners? This is Matt Faircloth, and welcome to the Best Ever CRE Show. I'm your host, Matt, and I'm coming at you because it's Friday, like every Friday, the Best Ever CRE Show with my segment called Next Level CRE is here on the airwaves for you guys to check out. So make sure you mark your calendars for every Friday. Make sure you like and subscribe this program to your podcast app, and make sure that you share this program with a friend to spread the word about Best Ever. Speaking of Best Ever, if you guys have been to Best Ever Con, then you guys know that Best Ever Con is the best ever conference ever to be put on in the entire universe, the entire world. I've established business partnerships at Best Ever Con. I've met people that are large of my passive investors with me at Best Ever Con. I've met vendors that I still do business with. I've met a lot of the core assets of my company at DeRosa Group have been assembled or interacted with or met for the very first time at Best Ever. So you, my friend, listening, YouTube, talking to you, need to join us at Best Ever Con. There's limited tickets left. They are selling out. We've got some great speakers coming down the pipeline, including me and all the other podcast hosts that are speaking to you on this program. We're all going to be there. So come hang out with us at Best Ever Con out in Salt Lake City in February. Go to besteverconference.com. And I got a free gift for you. Hundreds of dollars right here in my pocket. Here you go. Use the coupon code podcast10, the number 10, all capital letters podcast, and then the number 10 to get 10% off of your Best Ever Con ticket. So use that coupon code and I will see you there. Be there with bells on. Let's go have some fun out in Salt Lake City, talk some real estate, shop, and grow our businesses together. Now, with my guest today, phenomenal guest, yet another good friend of mine from the real estate investing space. I want you guys really to talk about, think about something. What about this business gets you excited? There's multifamily, but what about the real estate investing space gets you excited? And if it's becoming diminishing, maybe it's time to pivot. This good friend of mine has made a few pivots in the real estate investing space, and it inspired me about when it's time to make pivots for myself or for you guys or whatever it may be. Maybe you don't have to do the same thing forever in the real estate investing game. Maybe you can do something for a period of time and then look for an exit and do something else. And that's what this show is all about, talking about the different milestones and then graduation points to exit one thing and try something else. So with that, let's bring in my good friend Garrett Lynch onto the Best Ever CRE Show. Best Ever listeners, my guest today is Garrett Lynch, and Garrett is a former partner in Nighthawk Equity and now the CEO of Clever Investor. He's a seasoned real estate investor with many years of experience and somebody I've gotten to know throughout the industries. Garrett, welcome to the Best Ever CRE Show today.
Thanks for having me, Matt. Good to see you.
Good to see you too, man. Good to see you too. So let's talk through, for those that don't know, a little bit of your backstory, track record. Even before you got with Nighthawk, you were, before you partnered up with Drew and Michael, you were involved in real estate before that. How long have you been involved in the real estate space?
Just in the space, about 13 years is what I've been involved in. So I actually have two multifamily companies. One I fully exited. So I started one when I was 26. I actually started wholesaling apartments in Chicago, like in the south side of Chicago. It was like really D-class stuff. And that was how I got started. And then I transitioned into syndication with a buddy of mine who owned a bunch of houses. And so this was before there were any like coaching or anything out there about any of this stuff. It was just, we just learned it the hard way. We went and worked for a guy that had 1,000 apartments. And then we learned what he did, and then we took that and we were like, hey, we can line up some money. Found like an equity source, and then we just went in on a run and we bought like 3,400 apartments in about 3.5 years. That was, that was like years like 2013 to like 2016-ish, like around that time. So it was a pretty good time to be buying that stuff. The problem is we didn't really know what we were doing. And we didn't really underwrite deals. We just thought if we bought deals from 20 to 35,000 a unit anywhere in the country, like we'd make money. So sometimes it worked really well, and sometimes it didn't, depending on where you're buying. We didn't really underwrite that. We didn't underwrite to do like value add or any of that stuff. It was just like, all right, if we can do this, like somehow it works.
How big were these properties?
People give us money.
How big, are we talking like a couple hundred units at a clip, single site? Or are we talking like duplex over here?
We were in 10 markets. 10 markets, and every deal was at least 100 units, but some of them we had some 300 units, but we were buying them so cheap. Some were buying a $25K unit. like Columbus, so it was crazy. Yeah. So our max equity raise, I think ever was maybe like, I think the highest we ever got was 9 million. That was a huge deal for us, but a lot of our equity raises were somewhere in the 5 to 6 million range for that company. And we had a guy that was just like, basically like he acted kind of like he was kind of like a source for us. He would just come with the capital, write us a check. We'd make him a partner in the deal. And it was just unlimited. He would just write a check every time. And we're like, it's like one source really. So it's we got kind of lucky.
That his money? Like
no, it's his investors. This is investors. So, but he would come in on like as an LP and just write us a check. But he had investors that he, essentially was bringing on board. So it was kind of a crazy thing that we found early on. And then we were able to scale that pretty quickly. But we were buying like some in Oklahoma, some in Texas, some in Ohio. Yeah. So, it was like spread everywhere. And we had our own challenges with that. We had to self-manage everything. And you were
self-managing in all those states.
Yeah. In all those states, because we started with D-class stuff. So you couldn't manage the D-class stuff with property management companies. It just didn't work. There's no way.
Right.
So we started really early on. We got burned by a couple of management companies. We're like, shit, we're going to start our own management company because it's just such a heavy lift on these, Section 8 portfolios that we had in Chicago. And so it just kind of scaled from there. We didn't know what we were doing. I don't think we ran the things great. I mean, it was whatever. We were building it kind of wrong. We built from like the bottom up instead of the top down, like made every mistake in the book. So it was cool. Like the whole experience was great because then when I got bought out of it, I was like, I'm going to not do a lot of those things with Nighthawk.
Well, let's pause right there. So you ended up taking a buyout. Got it. What did you learn from that journey? Like life's all about like pretty much mistakes, lessons, and wins, right? And the wins are hopefully where you apply some of the lessons you got from your losses, or maybe just where you got lucky, right? What did you learn out of that? Sounds like a steaming hot mess that you made. No offense, what did you learn from that you were able to carry over in the Nighthawk?
So don't buy in bad areas was the first one. That was a huge headache because it looked really good on paper, and then there were all these expenses that came up. So were you dealing with like what are the results of buying in a bad areas? Because there's a best ever listener right now that's looking at a deal that's a 9 cap. They're like, oh man, I can't believe it. It's 9 cap, great deal. But you look at the crime map, and this property is probably at the center of the bad crime area, right? What are some like results that you see in buying in a bad area that end up kicking your ass? So it's the inverse of like A class if you're buying D class. So like A class, what is A class? A class is a big equity driven play, right? So it's like you're gonna buy. It's low cash flow and really high potential upside if you buy it right because it's in a great area, can appreciate like crazy, and you can sell out. D class is the opposite. D class is like there's very little appreciation, if any, and there should be heavy cash flow. The problem is you have all these unknowns that are going to happen while you own it. So like the tenants could be horrible and lose their jobs, which is at a very high rate in those areas. They are losing their jobs. So we had to switch everything to Section 8. Yep. Section 8 has its challenges because there could be a shooting on the block and then the tenant wants to move. The only way to move is to put you into abatement. They know exactly how to do that. Abatement means you stop getting paid, essentially. And so they'll fail a couple inspections, break some stuff inside, not let the inspectors in. And then next thing you know, you're in abatement, not getting paid, and then they can move. So you have people that know how to do that. And so the D-class stuff, the cash flow isn't safe.
So I got started as a Trenton landlord, Trenton, New Jersey, which is a C and D class market. There's some B neighborhoods, but the deals always look great on paper. It's like, oh man, I can make $1,200 a month and taxes are low and this and that. And if I can just keep it occupied, underscore that part, and not have very high maintenance, I can make a lot of cash flow. And sure, you can sometimes, but you would cross your fingers and pray that the tenant would stay in for a full year and everything like that with a lot of C and D class.
You just have so many unknowns. Like, we had tenants that were running drug houses and then the whole thing got busted and all of a sudden, the whole place is vacant. And, we had some tenants that because they were Section 8, they weren't vetted properly. And then but the government check came in regardless. They come in to destroy the place. So you renovate it. then you got to pay for the entire place to be rebuilt after they move out. And so
5, 6, 7, 8 grand. That could be all your cash flow for
more
the
than
year.
that. It was these were houses. Sometimes, we had big houses. They'd come in and just knock down walls, and you're like, the hell, like so. That just eliminates all your cash flow, and then you don't have the upside of appreciation on these properties at the same time. So when we went to sell everything, we were selling them for right around what we paid, but we hadn't really made much cash flow. And so and then after closing costs and everything, we were actually losing money. Yeah. So they were just horrible investments. At the end of the day, it was like just too many. And listen, there's people that know how to do this game and they want to do it, and it's fine. I'm not saying I've never made money doing it.
Yeah.
I made actually more money, I think, wholesaling than I did actually owning those deals. But the amount of headache and time you spend on those types of assets is just not worth it. And
there's ways to make money in C&D class. Don't get me wrong. It's just there's certain things you have to avoid, ways to, and you learn the game. I got buddies that own a couple hundreds units in C&D class markets, still in Trenton, New Jersey, where I got started, and they're killing it. But they've learned how to mitigate that. In that, I'm not saying it's the answer, but like best ever listers, there are certain equations. If you're gonna get into markets like that, talk to landlords that are already there and ask them what to do and what not to do. Because if you just look at the numbers are gonna add up, and they'll probably paint a better picture than what's reality.
Yeah. If you want to know a trick based on what Matt just said, I like to call landlords in my market, like if I'm coming into a market, and I'll get a list of like names and numbers of landlords, and I'll just call through them and introduce myself as their neighbor, and be like, hey, just want to, see what's going on. Or even before that, say we're looking at a deal and I just wanted to introduce myself, whatever. And you do what Matt said, where you're getting information about that market, but then in addition, if you end up liking the market, you have those contacts as people that could maybe sell to you direct.
Yeah.
And I've done deals that way too. So
it's so funny, Garrett, that in other industries, there's this concept of like, competition. Like they're not going to give you information. Like we've gone and secret shopped apartment buildings that are down the street from other buildings that we've bought, right? And people have been like, well, you got to pretend to be a tenant, right? Like, okay, you could maybe pull that off for some buildings, but I found you just walk in there and talk to the owner or talk to the property manager, say, hey, I'm going to buy that building a couple blocks away, and it's going to help you because I'm going to increase rents. I'm going to do value add. I'm going to help pull things up around here and they want more. It's like a collective. I find that landlords tend to look out for each other versus compete with each other. Would you agree with that?
Yes, I would say so. 100%. The problem with my style is I like to go steal people's staff.
Yeah. Then they're not nice to you anymore.
Dog in that sense, like there's so many, like it's hard to find the right staff, the right managers. So like I'm going in, I'm touring these places. I'm not only collecting data, but I'm like, hey, give me your card. And then
there's like a job interview.
Owners are not on site. I'm like, whatever. And like I've dragged site staff over. It's nasty, but like at the same time, like, it could take you years to find that right manager that's going to run your site right. And so I don't know. That's something I've done a few times.
That and had that happen to us. So it's okay.
It'll happen right to you also.
Yeah. So, I've
also talked to those owners. I've stolen their staff before and became friends with them at the same time. So it's
They get it.
They're like, whatever.
So any other lessons? So talk to me real quick about financing. For that C and D class stuff, were you doing like just local small community banks? Were at that level, were you going to agencies? Like, how are you bankrolling those assets?
Man, it was so dangerous looking back in it, but it was all local banks because that's like
personal
all
guaranteed
stuff. Personal guaranteed, all of it. Yeah, just so nasty, all of it. I mean, we had one deal that was seller finance. It was a big portfolio, so that one wasn't obviously as dangerous, but all the community banks, we like maxed out all of them. We're like, okay, they let us buy, they lend us like 5 million. We'd max all that out and go to the next one. And so that's the game we were playing.
Oh yeah. It's like roulette, right? Yeah.
Not smart. A lot of this stuff was not smart. Luckily I only was a KP on one of the loans, which in my buyout, I actually was able to acquire I put that as part of the deal, was that site. It was a pretty good site, but the rest of it was just, it was all recourse. And that's thank God we don't have recourse right now.
So at some point you left that business, took a buyout. Got it. And then you met
Yep.
this guy folks might have heard of named Michael Blanc and his partner Drew. How did that partnership come together? Were you guys just bumped into each other at a conference? Did you guys know each other ahead of time? How did all that go down?
So I after the last partnership, it was kind of like a nasty breakup, and I was just like, I took a hiatus for a little bit, and I was like, I don't know, I got to figure out my life. I had a bunch of money dumped in my lap, and then
bought some nice cars. I know you're like a car junkie, right? Yeah.
I was actually blowing through it pretty quick with travel and some other things I was doing. So it was kind of funny. I was just didn't know what I was doing myself. So I was looking at different businesses. I was starting little businesses and seeing if I could go anywhere with it. I was doing Amazon. I was, all this shit.
Yeah.
So finally I was like running out of money, and I'm like, all right, let's lock in here.
That sounds like a fun period of time right there. I wish I knew you. I wish we were buddies during that window. But yeah, I got it. Yeah.
Yeah, it was a very fun period of time. I was single, it was going crazy. And finally it was time to buckle down. I'm like, okay, I think I gotta get back into the game that I know the best, because that's where I'm gonna be able to make some money back. So I found Michael online. They had a program where you could bring deals and they do them with students. Okay. At the time.
Yeah.
So I was like, all right, well, I got Drew on the line, and Drew's like, well, we could sell you this coaching thing. And I'm like, I don't need your coaching, but if I brought you guys a deal, would you do it with me? Because I can find deals. And they're like, yeah. So brought him one. We ended up not doing it. Then brought him a second one. It was a pretty big deal. It was in El Paso, 545 units in El Paso.
Oh boy.
And they were like, yeah, let's do this one. And so I'm like, all right, you guys raise the capital. I'll do everything else. I know how to do everything else, and we'll buy this deal. And so we launched, and we put it under contract, and we just worked the deal it was pretty complicated. It was a 2-property deal. We were buying it at a great basis. It was a fantastic deal. The market, I love the market, actually. It was very steady, but I think it confused people. They didn't know, because there was seller financing involved, and there was loan assumptions involved. It was like a whole thing. And I think confused mind says no. And that's why it ended up not panning out, where we could bring enough capital raisers with us. It just didn't come to fruition. Ended up losing a lot of earnest money on that deal at the end of it. And it was under contract for about a year.
Wow.
So total earnest money. This is our first deal, and I'm already not making any money. And I'm like, this is my comeback deal. It's
Michael and Drew already hate you now, right?
Yeah, it's like $25 million deal. The capital raise is somewhere around $9 million. And we go a year, and we're talking about, I'm working it every single day for a year. And then it ends up not going through. We end up losing it. And I had every reason, honestly, to be pissed at them, because they were in charge of the capital raise on that side. And it didn't come to fruition, but we ended up not wanting to kill each other at the end of it, because we had pretty good communication throughout. And so it was a really a testament to our partnership and everything. And I was convinced them, guys, why don't we just work exclusively? You see what I do, see how I work. You guys had the balance sheet. I don't have the balance sheet right now. I blew through a lot of the cash that I had. But I'll work my ass off, and let's make this. Let's grow this business, and we'll make it just us three. And I think we can still do deals. And so we actually had a deal. A student brought a deal right behind that, and we ended up closing that 2 months after that one fell out of contract. So that was the start of everything. And it was a deal in Little Rock, Arkansas. And so we kind of, from there, we were able to just focus. I really helped build a lot of the company structure, and then worked with them too. We were raising the capital, and we scaled it up. We bought another 12 apartment complexes together since that moment. So yeah, it wasn't easy.
Yeah, but then it got easier, right? I mean, I'm sure it's because you guys hit scale, with Nighthawk at a point, right?
Yeah. I mean, the other thing I learned from the last business was it's better to go deep than wide. Yeah. So we were going deep, and we added one market in Huntsville, Alabama, and then from there we're like, dude, there's not enough inventory. We need to go in a major metro. So we're taking shots at Dallas, at Atlanta, and Charlotte. And then we're like, wherever the first one pops, we'll go and scale in that market. It was Atlanta. So we landed a deal in Atlanta. And then as soon as that hit, we had street cred, and then we started building off that and just end up adding a lot of inventory in that market specifically. Add another one in Huntsville, and then it was just off to the races at that point. And so I kind of took the lead on transactions. I had some rules that I created, some principles around transacting, which is just be like the easiest buyer possible, like be super, super seller friendly,
Mm-hmm.
And especially in a hot market, you kind of have to be that way to win deals. And then always close on time.
Yeah.
And if you can, try to close early. So especially in the markets, it was like time kills deals.
Yeah.
So when things were going crazy with COVID and all that stuff, I was like, let's close these deals in 45 days. So I was actually doing it. We're closing big apartment complexes, raising $10, $15 million, closing them in 45 days around that time. And that's how we stood out. That's how we were able to kind of scale and win big deals and best in finals and shit like that. So
yeah, and you probably were getting calls for the next ones too, because I think that's a good lesson, best ever listeners. I think a lot of people go in and they view a buyer seller transaction as an adversarial relationship, meaning like whatever dollar ends up going to the seller comes out of my personal pocket, so to speak, right? So yeah, that's the wrong way to look at it, don't you think?
It's a terrible way to look at it. I mean, but most people do.
Yeah,
you see, like. I used to see my first partner. He would always be like, getting in fights with the seller and stuff. And I'm like, what? I'm like, why do that? Like, just to, you'll never get another deal from them. I wanted to be friends with them at the end.
Yeah.
So any challenges we work through, there's always, every deal's got a challenge. Mm-hmm. There's always something that comes up, and any deal it's always different. Right. And so you have to work through that. Like one time it was the seller's numbers dropped off a cliff. And instead of me killing the deal and getting upset and all this stuff, I just said, just give us an extension. That's free. We'll sit in it, let you fix your numbers. And then when it's time to close, we'll close, but we can't go too long, but just, work with us here, stuff like that. And I would find that common ground in all the deals that we did. Yeah. And then there'd be times where I'd find stuff and I'd give them like a gimme on it. And they were like, I can't believe you guys did that, just because it, like we'd find something they didn't mention or disclose. And instead of me beating the shit out of them, like, what, I think I'll give you that, but give me this and over here, give us, whatever, more time. Yeah. And they would appreciate that. And then like I would see them at conferences and stuff, and we had a great relationship, and we'd buy multiple deals with those sellers. You can go on a run. Yeah. You can get one guy and just buy all their stuff, and they're
looking to do an exit. Yeah. Do you try and get, when you do a transaction, is it imperative for you to try and get the seller on like direct contact? Because a lot of times these brokers tend to try and run interference and try and stay in between. They want you to play telephone. They don't want you talking to their client direct, so to speak, because they're worried you're going to screw up their commission. So, I think, so what's your angle on that?
I think it depends on the broker. Like I generally I want the brokers to get paid, and I want them to be involved as much as they want to be. But at the same time, there is a moment where it's like, guys, just get out of the way. I'm going direct to the seller to get this deal done. Shut the hell up. Yeah. Let me get this thing closed, and just keep your grubby paws out of it. I've gone that route many times also. Yeah. And like, guys, if you want to get paid, you did what you did. You marketed the deal. You got us. Just let me close it in 45 days and collect your check. And I don't want to deal with that. I don't want to deal with whatever you're talking about.
Most of the deals that have gone the smoothest for me are ones that I'm talking direct with the seller or the buyer directly. I find that too. So then Nighthawk continues to grow. Now we've talked COVID. What did you see in the market? I mean, again, how did the market changes affect you and your business and your affinity for continuing to grow multifamily? I mean, it really knocked the soul out of a lot of people that I know. And I've had some heart to hearts with you over bourbon and stuff like that at events and stuff like that, talking through all the stuff that both of our companies are dealing with all the changes coming down the pipe. What came up for you with all those changes that multifamily's seen over the last couple of years?
So a lot of things that, we had two Black Swan events back to back, right? So like COVID was a huge positive movement for apartment. First, it was scary. Everyone didn't know what to do. And then you saw.
We knew it was going to be positive. We all thought, it was all like, holy shit, what's going to happen? Are they going to be able to pay, our residents be able to even pay anything? May, I don't know. June. It was
July. It was the craziest thing I've ever seen. Like, we thought we're doomed. And then it was followed by like, holy shit, our values are going to the moon.
I don't know if anybody saw that boom that happened, but I mean, it just went ape shit.
Bananas.
From 2020 to 2022, the market just went, it was going on a tear.
We couldn't, like, the amount of interest in these deals, every deal was hard money, crazy hard money. Every deal was like best and finals were insane, like jumping over each other.
Why? I mean, I have my theories. I want to hear you go first. Why do you think multifamily blew out from 2020 to 2022?
Well, I mean, it was a combination. It was a perfect storm. You had inflation that was working in the favor of like inflation plus the PPP money that was coming in at that time. So it was just like this influx of cash, and then there was normal supply that was there, and so what would happen was you had all that. Like, yes, costs were going up, but at the same time, rents are going like crazy.
Yeah,
and so you could charge more, and then interest rates were staying low.
Yeah.
So you had virtually, I think we're at like the 10-year hit like zero, or it was like very like extremely low.
Yeah.
SOFR was like at zero. And so you have this really low interest rate, really high rents all of a sudden, all collectively at the same time. Is like the perfect storm. So the valuation of your property that you just bought like doubled, and so you had this like false sense of this is the reality now, and this is going to be good. I can't see anything going wrong here. They can't raise interest rates because they'll crater the market. That was everyone's theory at the time. So everyone's like, they're not raising interest rates. And so everyone's going gangbusters.
I think
and
you
just
nailed
trying
it.
to buy jumping over it.
On the other side of it, like there's all these buyers that had all this newfound money, PPP loans, and just money, all this trillions of dollars that got printed was all looking for a home, right? And on the other side of it, you got residents who also benefited from all the money that got printed because a lot of them got stimulus checks and all this kind of stuff. So there was a false sense of propping up in the affordability of multifamily. And that's how people like you and I and other landlords, like, yeah, you and I are good landlords, but there's other, just whatever. Rents went up a lot not because things, because America started becoming lots more prosperous and people started getting salary increases, is because all the money in the market that people were able to afford to pay more rents through stimulus and everything like that. So I think we saw a inflated run up on both sides, on the revenue side of multifamily and on the buying side, on the acquisition side of multifamily, which created this perfect storm where all of a sudden NOIs are looking better than they should have because revenue was popping 15% a year on some properties. And as you said, interest rates were down, money's cheap, that whole thing. So yeah, it was a perfect storm. Then all of a sudden,
wild time.
Yeah. Then all of a sudden,
so the only way to win deals at that time was to use bridge loans. And so you had these like projects that you're like, okay, I'm going to do this big value add project. The bank's going to give me a high leverage. The bank's going to give me a bunch of construction dollars. I don't have to raise as much. All of a sudden, a deal size went from 20 million up to like 50 million. We're like, shit, we can do these $50 million deals now almost. Like, we raise all this money. There's all these investors that want to come into deals we've never seen before. It was like gangbusters. And then
85% loan to value going in on the buying side, 100% construction.
And no one's...
And that 3% interest rate. Yeah.
Right.
What could go wrong?
So what could go wrong? Right. Yeah. How wrong were we? So, So then all of a sudden interest rates start to hike.
Because like Jerome Powell wakes up, the Fed wakes up and says, hey, wait a minute. Well, something's going on the last 2 years.
Inflation's going out of control, and we're going to hedge that. And so
he let it go for 2 years, and then all of a sudden he's like, "Hey, well, there's all this inflation's here,"
and
then he just starts cranking rates,
billions of dollars.
Yeah, he started cranking rates overnight. It felt like overnight. I know this didn't happen that way, but it felt like rates went from 3% to like 8% in like a week. I know that's not what
happened over 18 months, but it was like just 75 bip rate hikes, 75 basis points, 75, like nonstop every quarter. You're seeing a new hike and you're like, okay. So I like started to sense this after like little before the first rate hike, it was the first rate hike hit. And I was like, ooh, this could get nasty. So I went and I refied a couple deals like right in time. But there were a number of deals that we just had bought. And we're in the middle of the construction project. And I'm like, we can't even do that on these. Like there's no shot. Right. So we got kind of stuck. And then as these rate hikes went up, values started to drop. Yeah. And then it keeps going and you're seeing all these things happening. And you're like, oh shoot. Debt service is going up. Oh shoot, the caps that we put on these variable rate loans are ending.
Yeah.
Oh, the values
collections. Oh shoot, collections are going up.
Yeah.
You know, because all the money that middle America had that where they were, no problem paying their rent started to dry up a little bit. And so I'm sure you've heard this too from other folks in the industry, but collections have gone way up the last couple of years. That's like the one thing that doesn't get talked about. Then throw in, sorry to keep to yes and on top of you, somehow or another, the insurance companies catch on to the money grab going on, and they're like, hey, I think that we should triple our rates.
Yep. Then insurance hits.
Yeah.
Taxes are still an issue.
Right.
Then your payroll goes up by 35%. You know, like all the inflation stayed and hit with all your expenses. Then your rents are dropping. So your rents start dropping because of the deliveries. So you have in a lot of the major metros, you had everybody starting during COVID. They started a bunch of new starts because money was so cheap. So they're now building. All those deliveries are starting to hit as interest rates are going up. And then, so the supply goes up. So then all of a sudden your rents go down. Yeah. And you're like, shit, the rents are going up $500. Now they're going down 600.
Yeah.
What?
Because all those knuckleheads who are building apartment buildings are now trying to give away their units for concessions and stuff like that. Right. Yeah. Yeah.
So now you went from like keeping most of the money that you had because of the low interest rates, all this extra rent, all these distributions, it's really high NOI to your NOI is getting squeezed. Now you got to pay the bank an insane amount of money. Now you got all your rents dropping, so your revenues drop. Now you got to pay insane expenses. Everything got compressed.
Oh, you didn't mention rate caps yet.
Well, yeah, the rate caps went nuts.
I remember, so for the best ever listeners that don't know what a rate cap is, what a rate cap is an insurance policy that you have to buy in essence. Your interest rate is X. The rate cap is going to artificially reduce your interest rate down to X minus a certain number, right? So that your interest exposure on your property is fixed at a lower number, right? Back in the day, used to be, you could buy a $20 million property and have a $10,000 rate cap, $20,000 rate cap. Like you said, you didn't even notice it. It was like a rounding error on your closing statement, because rates were at 3-4%. And the bank just wanted to make sure that your rates didn't get to like 6%. And so it was just a little insurance policy. Now, with the rates being like 8%, they were making you buy the rate down to 6% in essence, which was not $20,000, put like another 0 or more on there. And so these were unforeseen expenses, that a lot of multifamily owners that bought, between 2022 and 2023 had to deal with all of a sudden unexpectedly.
Yeah. Like the rate cap is basically there it protects you. It's a derivative you buy. We would get upset because they went up a little bit. We're like, wow, we used to spend 15 grand. Now it's 50K. What the heck? And then they all of a sudden went to that same rate cap, went to $1 million. You're like, $1 million for a rate cap? Like, I didn't plan for that in my business plan. And you're in these bridge loans they're 3-year bridge loans plus 2 extensions that are impossible to hit. And then you're supposed to be covered for 3 years with an interest rate cap, but usually we're trying to finagle out of that third year. You get it for 2. So we did like 2 years because we were like, we don't want to spend this extra money. Mm-hmm. And then that was like horrible. Like 2 years on fire. We're like, oh, shoot.
Well, I know you would, I'm going to pause here because there's some best ever listeners that are over here. They're probably in tears now while you and I talking about all the awful shit that happened in the multifamily market the last couple of years. But I know that you and when you guys were, working stuff out at Nighthawk, you guys were able to get fairly creative with your lenders, right? What is some advice you would want to give to a best ever listener right now that's listening, that's got a bridge loan, that's still trying to scratch their head and figure it out? What are some creative strategies to doing work? And I got a few too for doing some of these workout negotiations with banks.
Yeah. So initially, like anything, if you need legal advice, you hire a lawyer, or you need tax advice, you hire a CPA. Like, we thought we needed an advisor for these because we didn't know what to do with the stuff. So we did hire an advisor, and then it ended up being a horrible experience because we didn't realize the banks didn't want to deal with those people. And so we had to fire her after the first meeting. Jeez. Went terrible. We had already paid her too. We're like, shoot, fire her. So now I'm out in the Wild West myself, and I'm like going up against New York, and these big multi-billion-dollar,
all in New York,
debt funds in New York by myself. And I'm like, shoot, I don't know what I'm doing here. This is crazy. I've never had to negotiate a loan mod. So once we got into it, it was more, they wanted to hear from me directly and they wanted to hear all the issues we were having. And so I was just very upfront with them about what was going on. We discussed it. And, there were things like, I think the first thing you do is ask them what they're doing for other people that are in similar situations. What have you done, guys? Because we're not the first ones that have had this issue. How have you worked with other borrowers in a similar fashion? And they typically have like a playbook. They have something that they've done that they will suggest, hey, this is what we've done, or some version of that. And then you just have to go and tweak that. And like, okay, if it works, if it makes sense. Initially, the playbook that we got was horrible. We're like, oh, we can't do any of these things. And then it changed to a different one. And we're like, oh, this one actually seems like it could possibly work, but let's massage it a bit. Let's figure out.
They're in essence letting you know what's already been approved and what they can get approved easily through their loan committees and everything like that. You can ask them for the sun, the moon, and the stars. But what you're saying, Garrett, is you're saying like, what do you can get through for me? And you probably look to see if you can make that work. Then you don't want to be the squeaky, be the squeaky wheel, but you don't want to be unrealistic with what the bank's going to be able to give you.
Yeah, 100%.
Okay. For examples, what are some concessions you were able to, and I'll give a few too. What are some concessions you've been able to get a bank to make?
Yeah. So like, and I'm just generalizing. I'm not saying anything specific about any specific bank, but like one term that is out there that can be used is you can take your interest rates. So let's say it's 9%. And you can split it into like a hard pay, soft pay. So you have a certain percentage that you pay now as to help with cash flow. And then you defer the other part to the end of the loan when you go and exit. Okay. If they won't give you any kind of debt forgiveness, which we didn't see a lot of out there, then you can set it up where they still get paid, but it's later and you just pay that lower amount now. And so that was a concession that we've seen out there, that you could set it up like that. As an example.
That's great. I'll give an example of one too. And then this is what I think this is already maybe foregone conclusion when you're describing that, but we've had banks obviously forgive the requirement for a rate cap, because at the end, like rate caps have gotten to the point where if you say, okay, if I were paying full burden interest of 8%, let's just say that's probably a good rate for today, and I need to be bought down to 5.5%, then that probably would cost me $40,000 and an extra $40,000 a month is what that would cost me in interest. So if I need to have a year's worth of rate cap, the rate cap's probably about, 12 times that extra interest with a small little premium, small little commission, right? So the bank kind of gets it. So they see you've got enough cash reserves, especially if you've got a tighter window to get out. I've seen them just like, okay, just pay full burden interest, a rate cap. And that means you have to shell out all that money up front. You just have to pay it monthly. And if you've got a exit coming up, with a sale or a refinance or whatever, that's a great way to bridge it without having to pay a bunch through the nose. I love that hard pay, soft pay idea. That's great.
Yeah. That was a huge one because that did eliminate the need for interest rate cap. Like interest rate cap, what is it really? It's you prepaying the interest. It's kind of what it is.
That's all it is.
It lines up about with what you're going to pay in interest over that time frame.
Yeah.
So they give you a certain amount of time. That's all it is. It's a hedge.
That's because those that like the smart guys that create those rate caps have figured out that rates are not going to go any higher. So there's no premium in there, right? There's no like additional fee just in case rates go any higher than they are. The rates are pretty much at, it's as if you were going to just pay the full burden interest rate times 12, right?
That's right.
So we've been able to get the bank to work with us on moving money around in the construction budget. So like, okay, I need you to put this over here, put this over there. And if you can show them, hey, listen, this is going to help us get the asset to the promised land. So I need you to take this amount of money out of roof repairs and put it over here to unit turns, whatever it may be. They're willing to do that. You know why? They don't want the asset back. They want to help you get out. And I think if you remember that, best of our listeners, that like, talk to the bank direct, talk to them one-on-one as Garrett did. What were you going to say?
The landscape is just changed, right? So like your initial plan may have been, I'm going to spend $15,000 a unit because the ROI was there in that unit. Okay.
Yeah.
So the way we calculate the ROI, it's the cost of whatever it is to do that specific unit. And then we figure out what the rent bump is going to be for that cost. Okay. And I actually learned this from Reed. And then we'll multiply that times 12 and then divide that increase by the cost of the unit. So let's say it's, $10,000 and you've got like, let's say you're going to get a $100 rent bump for that $10,000 increase, $100 a month, $1,200. Yep. You divide that by your $10,000 and you're going to get 12% or whatever it is, whatever the math is on that. So that is, you want to be at 15% or higher typically. You can move it however you want. But what we're doing now is we'll take that. Like, let's say we signed up the lender. We say we're going to do $15,000 renovations or $10,000. We're going to go to them and say, hey, listen, the ROI is not there. Look at the new ROI. Okay. It's negative because of the rents decrease. So it doesn't make sense for us to rehab. So I don't want to increase my unpaid balance. So when you get a bridge loan, you start with a certain amount that's at closing. So let's say it's a $20 million purchase and they give you $15 million. They're going to give you CapEx funds on top of that. So it's going to be another, say, $4 million. So you can ride that unpaid balance all the way up to $19 million, the 15 plus the 4. Okay. But if you don't use it, your unpaid balance stays at around 15, 16 million, depending on how much you use. Now it's easier for you to refi out of that or sell out of that. But if you ride that, use all the construction dollars, now your unpaid balance goes up to 19. It's harder to hurdle all that when you want to sell or refi. So we want to go and make the argument and say, listen, the ROI isn't there. It doesn't make sense for us to spend all this money on a per unit basis. So here's the new cost. We're going to do a lower cost. Let's say we're going to spend $5,000 on these units. We can get a good ROI on that. Now, if they agree to it, we've satisfied their requirement. There's typically a guarantee on the construction. We've satisfied their requirement and we've lowered our overall exposure on the unpaid balance in doing just a modified unit turn, essentially. So now we're spending less, unpaid balance stays low, so it gives us a better shot at getting out. ROI stays healthy, and we didn't have to use all those construction dollars on a bridge loan. That's the pivot that we're making now. And so you just have to talk to the bank, show them the numbers, make sure they're okay with it. And if they stamp it, then you're in a better position.
It sounds like, so you've figured out a lot of these sleuthing and working with these banks and negotiations and everything like that, but you've still decided to get out of the multifamily acquisition space. It's been a great ride. And why did you make that decision that, like, you didn't know? I mean, it sounds like you got pretty good at it, right?
Good at all these things, but like, I'm playing the game to lose, not to lose. Not playing to win. I'm just playing like, how do we do our best to, we're so far below, the values have dropped so far that it's like, okay, we're just now fighting to maybe not foreclose on deals. Like that, the bar has gone from maybe making money to maybe getting investor dollars back to maybe not foreclosing. Like it's dropped so far. On a lot of these assets, it's gone so far one direction. So it's like, okay, fine. So it's a combination of that plus transactions have just slowed way down. Like we're just not doing a ton of transactions. I don't think I ever aspired to only be a multifamily owner. That wasn't all I wanted to be in my life. And I've done it for 13 years. I know all the pros and cons of the industry. And I think I just did a full assessment of everything. I think little part of it was, my partnership was having some issues. Michael and Drew are amazing people, but I think the way that things are working, it just wasn't. That was a factor. Plus all the stuff that had happened. I was like, I think I'm ready to look at other potential opportunities for now.
Yeah.
Not saying this is going to be, I know how to go syndicate apartments. I can do that all day. But for this exact moment in time, we're probably going to have to ride through this for another 3 years ish. I think it's going to take that long to really start to see things change. Let me go see what else is out there. And I just had an opportunity that crossed my plate that I couldn't ignore. It was just, it was an unbelievable opportunity. It was a way for me to still maintain my presence in the real estate space, but kind of a different angle, a different avenue for now. And it was a way for me to continue to maintain my influence in the space but with a louder microphone and a new partnership that was refreshing. And it was just like everything. So I still partner with Michael and Drew. We still own all these assets. it's still, I talk to him every day. It's still a thing. Like we're good. Like everything's fine. But when this opportunity came, I was like, if we could put this deal together, this could be a massive, massive opportunity for me. I looked at it almost like when people were trying to buy Bigger Pockets and someone bought Bigger Pockets. This is like my version of that.
Which time?
And so it's like, it's an old brand. It's been around for 15 years. Mm-hmm. It had a staff that came with it, a small staff of like 10 to 12 people that had been around for about that time, like a long period of time. And it was in a state where the seller had essentially sold it already to somebody. And it's an info marketing company in real estate. And then that person had screwed it up and defaulted on the note and gave it back to him. The seller financed it. So this was a friend of my new business partner, Vina Jetty, who you guys all know.
Of course.
Probably, or a lot of people probably know her in the space. She's done some big things in multifamily. And so she was the one that connected the dots. And we just started talking about it early this year. We're like, hey, like, could this work? Could this be a thing? And is there an opportunity here? The answer just kept being yes. I was looking at other stuff and I was like, this feels so right. I had exposure to this type of stuff through Michael, because Michael's, fantastic on his side, his marketing abilities. And so I already had a familiarity with the space and I'm like, okay, let's see, where's the opportunity here? And it was a very scalable company. We realized that the only way to make it work was to keep the seller in the deal. And then we were just going to he was checked out of the business. And so it was like, I was like, I could come in here and bring life into this thing if we got the right deal and the right setup. And so I was very excited about it. And so we worked on the deal. It took like 5 months to put together the whole thing. It was a bit of a challenge because it wasn't exactly bankable at that time with everything that was happening. And so we're just trying to understand what we're doing here. But at the end of it, we worked the deal out. And Vina and I ended up purchasing a majority interest in Clever Investors, the company. Mm-hmm. And this company was booming like 2015, 2016, 2017. Like it was the place to go for real estate education, mostly like in the wholesaling, flipping space, all that stuff. But when I joined in, I'm like, man, this team is amazing. This company is amazing. It just needs a facelift. It needs some work. And so I've been the owner of it for the last 4 months. And it's just like, I'm getting up every day excited again. Like I needed that excitement back. I lost that.
Well, let me just pause you real quick. What happened over the last 3 years could suck the excitement out of anyone, right? Anybody that was involved in this business. I mean, like I said, it used to be a lot more fun of an industry. It used to be a lot more sexy. It used to be a lot more, it's just low, like, I don't know if risk is the word or whatever it is, just less of a pain in the ass. How about that? And it really has sucked a lot of the joy out of multifamily the last couple of years, because it's just, I'm not saying multifamily was easy. It was sure difficult. Doing value add stuff, even in the 2000 teens, were still difficult work, but it was more rewarding than it is now. And it was more inspiring than it is now. So I get it, man. I get it. You're not the only one that I've talked of that said, you know what, forget this, man. Life's short. I'll keep what I got, but I'm not going to grow anymore. I'm going to go get to something else, I know so much about it. So it's like, I'm not saying never again. That's not my position on this. My position is, it's like, for right now, this is what I want to do. I want to start to live again. And I want to start to, there was a time in multifamily where I couldn't wait for Monday. It was like Sunday and I was, like Gary Vee said, he's like, I can't wait to get in the battle the next day. And like, it was lucrative and it was fun and it was challenging, but it was worth it. And imagine doing, even harder version of that, like just way more difficult, but you're just like, I'm just trying not to foreclose right now on multiple units. And there's no chance of me making another dollar. And it's not all about that. Like I really wanted to do my fiduciary duty to my investors and all that stuff. And that's why I'm still doing it. But I needed something that was going to light me up again. And so it was like, this isn't goodbye forever. It's goodbye for now. Yeah.
And
well, also like you're keeping what you got. You're maintaining what you got. Yeah. You're probably still talking to banks and
still
everything
got equity
like that.
Deals. I still got investors. I'm still talking to people.
Yeah, but you probably had the light bulb moment to say, why do I need to go try and double up again? Why do I need to grow? Whatever it is. It's kind of a weird time to be growing, weird time to be looking at multifamily and everything like that. My company's bought very few, I think like a handful of multifamily deals. And they've been off the market, kind of like off the beaten path multifamily deals, not middle of the fairway stuff. Most guys I talk to have not bought in the last couple of years because of how weird multifamily's gotten. So I understand.
And you did like, didn't you do like, you did some other stuff? Like had another couple like venture and hard money lending or something?
We have a debt fund that's issuing hard money that's crushing it. Right. We've gotten involved with a couple of builders, guys that are building multifamily or buying properties from builders as soon as they're finishing them. That's a good arrangement. But buying like typical value add stuff that you and I used to do, like B class, C class stuff, that's a tough gig, man. And I used to love that space, Garrett. I used to love C-class value add. You're making freaking home a better home for middle America. Are you freaking kidding me? Show me a more noble thing than that, right? I'm giving them a better living. I'm giving them like gardens and better roofs and windows and, just a more stable, more secure, throwing the knucklehead, like the gang guys, knuckleheads out, making it more of a safe place. I bought a property where there's a big open field. One of our tenants came in, he found a needle in the field right before we closed, right? From a drug thing. We cleaned that property up. We put a playground on that field, not, without the drug needles and stuff, but we got all the druggies out and everything, right? And so really that's inspiring. It's tough to be in that space anymore because just the numbers just don't work. I hate to be like that. The debt doesn't work. Prices don't work. The rents aren't there anymore. It sucks because I love that space, but I got to put it on pause too. I'm like you. So I got to get my stuff in other shit.
It's like I got to deal with the issues that I got every day. There's something new with the existing sites, and lenders are going nuts right now. They want an inspection every week, it seems like.
Man.
So there's stuff like I'm managing the risk on that side, but at the same time, I have like this brand new revived energy and this other space. I think they're in the midst of all these challenges are happening. There's properties that are going back, all this debt that's coming due. I'm like, okay,
what's the workout look like? Yeah.
Yeah. Like, well, what could I sell that's like how I did get started? There is an opportunity coming at some point in the space. So the first project we put together was like, okay, how I got started in this game was by wholesaling multi. It's different than like these single family home deals and all this stuff. Like, let's put together like a whole program around that at Clever. And that was our first product that we launched. It was Vina, myself, and Cody. Like Cody was doing a ton of wholesaling. He's done a ton of that. Vina and I have done a ton of multi. So we just kind of like combined forces, came up with this amazing program, and then launched that out there, and it's going nuts. Like people are going for it.
Tell us about it real quick. Look, in the time we have left, what is Clever? What is it? What problems does Clever help solve? Give me that real quick, because I think
Clever investors.
I love to see how excited you are. Yeah,
dude. Yeah, it's like the OG, super cool. It's like a really cool place that is mostly online education and mentorship for people that want to change their lives doing real estate. So they want to get into real estate. They don't know how to do it. There is something we have at one point, I think over 400 products here. The company at one point was doing 25 million in revenue a year. It was a huge company. And so it's trimmed down a lot, but now it's just it was the go-to place for, if I want to learn how to get into real estate, where can I go where I'm going to get the best education? The fulfillment is insane. The offer is insane. The quality is insane. And so there's all kinds of, it's got saturated. The market is stupid, gurus and all this stuff out there. But now like Vina and I have actually done the business. And so we're like, let's bring a fresh take on it with our actual deep knowledge and throw some products out there that people can actually use that's going to get them in the game. And we're going to start an industry that's taking a hit where they can start at the bottom. And let's start there and build, right? And so there's, with AI, that's all the stuff we're doing with AI on that side. That's super interesting to me. We're already integrating all that stuff into the business. It's super scalable because we can reach the masses. And so what we're basically doing is creating a product or a series of products, and we can do it over and over again with different ideas in a way that's going to help people get into real estate in a few different ways. And then we have a monster email list, and we're marketing that. And then we have different options, different products that will sell to someone. If they want direct access to me and Vina and Cody, that's going to be more expensive. If they want to go a step down, that's a step down. Like, there's different levels for people that want to do it, right? And so all levels, but we offer like a full package for people that really want to learn. Because listen, as tough as it is right now in the multifamily industry, there's other areas of the industry or different asset classes that are doing just fine. There's also going to be a turnaround. And so I think right now is a good time to get yourself educated, get in the game, understand what's happening. Because if you can get through this, there's going to be cycles go up and down. When it's going back up, and you're right there,
if you can get through this cycle, those that are still standing after this thing are going to be standing on. They're going to be standing very pretty, because I think I think it's going to go maybe not double again. I hope not, but I hope it just gets healthy again, right? So Clever, is it just multifamily, or is it all the different asset classes? No, is it who does it help?
Historically it's been how to wholesale, just in general, like homes. Like, it's like a wholesaling, flipping type education. It's been that in the past. It's been like the bread and butter of it. But what we're bringing in is a fresh new look into. We're kind of merging multifamily in, because we know that game, right? So there's a way you can you can wholesale apartments, and it does work, and you make bigger checks. But there's also, you can do the same thing with RV parks. It's a whole new angle on stuff. Like, we have a guy that the product that was launched right before ours was how to do this with commercial. And he does that full time, and that's how he makes his living. So there's different angles on that. But another option that we're looking into right now is how to build an AI generative bot that combines all the knowledge of myself, Vina, and Cody into one specific, off the grid. It's not on an open AI or any of that. A way that you can tap into our knowledge and experience and ability to get any answer that you want at any point in time during a real estate journey. And it's accessible to you. Because I only got so much time, Vina, and same with Cody, right? So that's like a cool thing that we're in the middle of working out right now. That's going to launch, that people are like, oh, that's pretty cool.
Yeah.
There's a lot of ways that it goes. And so
love it.
Yeah. It's a fun space to be in.
So tell me, okay, so for those that want to hear more about Clever, and I know there'll be more conversations around this and everything like that as you and Vina get it off the ground. Love a lot of your backstory, but for those that want to hear more about Clever or reach out to you, how would they be able to do that?
Yep. So you can go to learnfromgarrett.com. Just go there. That we've got something that we're giving away right now, which is it's a 28-day wholesaling multifamily properties, like a guidebook. It's free. So you guys can go there, pick it up. It's learnfromgarrett.com. Just start to thumb through that thing. It's got a ton of great information. Myself, Cody, and Vina personally wrote it. So that's a freebie that you guys can pick up and learn just more about what we're doing over at Clever.
Learn from Garrett, GARRETT.com. Learnfromgarrett.com.
2 R's and 2 T's. Yep.
2 R's.
Learnfromgarrett.com.
And Clever without a vowel, CLVR, right?
CLVR is this is just a branding thing, but it's CLEVER, Clever Investor.
Okay, it's the correct spell. Okay, cool. Clever. Got it. All right. I look forward to seeing more about where you take Clever. I think that there is a really interesting conversation about the real estate arbitrage space. What a seller is willing to sell a property for and what a buyer is willing to pay for that property is not always an equal number. And as a wholesaler, it's really about arbitraging those two things, making something in between there. And if you've got a seller that really wants to unload a property and a buyer that really, really wants to pay for that property, you can do real well on the in-between stuff. And I love that you guys are bringing that wholesale concept into larger real estate. I've been waiting to see who is going to be the one to champion that, because right now it's only been really present in the single family home space, but I think it's time due to get the wholesaling technology there in the other real estate asset classes too. So looking forward to hearing where you go for it. Love your new energy around it. Thank you for sharing some of your backstory here and kibitzing about the market a bit on the Best Ever CRE show today.
Awesome. Matt, thanks so much for having me, man. I really appreciate it.
Guys, really love the conversation with my buddy Garrett. Known him for years. I really love hearing about his new venture over there at Clever, and talking about bringing wholesaling to all things commercial. Exciting stuff. And I loved hearing about his journey and evolution through real estate investing. I hope you guys enjoyed it too. If you guys enjoyed it, do me a huge favor and like this program in your favorite podcasting app. Do me a favor and share this program with somebody that you know in the real estate investing space to spread the word about the awesome stuff going on at Best Ever, and come see me at Best Ever Con. There's your homework. Until then, come see me next Friday here, and come see all of our other podcast hosts for their contributions to Best Ever CRE coming at you on a daily basis. Thanks again for listening, guys, and have a best ever day.